Well, to discuss this and plenty more besides, Michael Frazis joins us now from Frazis Capital Partners. Michael, just to get us going, because we've been following the Moderna-Pfizer story with you really from the beginning, but do you have any view as to whether or not these companies and manufacturers should be forced in a way to distribute more vaccines and increase manufacturing to help, in particular, the southern parts of the world that are suffering more from COVID at this time?
It's a tough question. I mean, usually in pharmaceuticals, generally they distribute, they generally charge huge amounts in the United States, lower amounts in the rest of the world, developed world, and then, you know, donate or provide at cost treatments to the developing world. So I guess most of them should probably be doing that now. This is like an unusual time though, because there's such an urgent squeeze for vaccines. And it's not just, the need is not just in places like India and places like Africa and South America, it's also in Western countries as well. So I think, should they be forced? I doubt the politics of any country will allow the distribution of free vaccines easily. You know, if anything, citizens will be demanding that more are kept, you know, for their own country and their own regions, as you've seen with the EU. Mm-hmm. You know, it's still such a shame that Australia doesn't really have access to this vaccine. I mean, if you think about it, there must have been some combination of cost and also perhaps trying to manufacture, you know, more vaccines onshore. You think about the hundreds of dollars that were paid to everybody or to so many people every single week, you know, paying $40 or $50 for a vaccine, there's so much value there. But it's a real shame that, you know, Australian politicians have missed the ball on this one.
Yes, we are a little bit behind the curve when it comes to global trends, of course. Look, Michael, I know you keep a close eye on what's going on in the IPO space, the SPAC space as well. What's caught your eye domestically at the moment? What's the opportunities that are out there?
Yeah, look, there's a really interesting one, which is travel related. So like many people now, we're slowly orientating our portfolio to more recovery. Stocks will benefit from a recovery. So there's a local one that was reported in the AFR, and we've had a chat with them as well. It's called Camplify. So they're kind of like an Airbnb for caravans. So you basically put your caravan on there. They'll handle all the insurance, all the logistics around renting that out. And people can then go and rent caravans. You know, a caravan might be $60,000, $70,000 or more, and you can potentially generate, you know, 10,000 plus over short periods of time around holiday seasons. So it's a very capital light business model. They don't own the caravans. They just connect the owners and people that want to rent them. And they're coming to market soon. You know, they've compounded growth at over 100% for 3 years now, at 130% this year, roughly. You know, it's an extremely exciting company. It's one that we'll be watching very closely.
So you have had a chance to speak with management there, Michael. I mean, where does the growth come from in the longer term if you think that there is, you know, a cap on population? There's no migration happening right now either. I mean, do they have to look to expand overseas? And is there, you know, a market that they could potentially roll it out into?
Yeah, there's two things there. So they are expanding overseas. They're in Europe. They're in places like Spain. They've been very clever about how they go around selecting their geographies. They look for places. I mean, as you know, there's so much data online. You can see for free on Google Trends, you know, where campervan interest is going up. There's also a structural thematic. This company was growing extremely fast before the crisis. The second part of what you mentioned is kind of like how will that kind of play out, you know, going into recovery. You know, there's no doubt there probably is some element where they benefit as a source of domestic tourism. Perhaps as people travel overseas, they'll be less likely to do so. These things are very hard to tell. So the way we're approaching these things is to really go back and see how they were growing before the crisis, and then try and figure out how big the market is and how much room they have to grow. In this case, you know, they have a tiny fraction of all RVs. Most RVs are empty almost all the time. It makes all the sense in the world to rent out that spare capacity. And similarly for the users, you know, it makes a great family holiday for people to just take a van for a week or two. So it's one of those things that just makes sense from all sides. But most importantly, they're delivering and they're executing, and you can see that demand on both sides in the numbers that they're providing, which were reported in the AFR, I think yesterday or sometime this week.
Yeah, we're following it. It's interesting because you're right, Michael. I mean, if you own the camper van, you've got to pay for storage, you've got to maintain it. But it's a bit of a hassle. You've really got to be committed, but fantastic to go on a holiday, make a mess of the thing, tidy it up a bit, and then hand it back over, right, Scotty?
Yeah.
That's my kind of vacation.
I don't want to clean up. Yeah, over to you. Michael, when it comes to
right?
US...
They'll handle the insurance. They'll repair all the damage themselves. So cool. they'll help you with that.
I
value
wouldn't
add.
damage it. Michael, when it comes to our big tech earnings in the States, we had a huge week last week. Mind-blowingly large increases when it came to a whole bunch of growth metrics, including revenues in particular. But there wasn't a huge share price reaction, though. What did you make of the market's reaction to such good news?
Look, I think there are a couple of things you can draw from that. I mean, the first one is, as you say, there wasn't a huge reaction, but the big tech companies have been much more resilient than, say, the rest of the growth phase. I think there's just been a huge run-up, and you've got to look at these things in the context. If you look at them over a day or a week or a month, you probably won't see the big picture, but if you look at the huge moves across technology over the last year, like those 12-month numbers are huge. And the returns were made for buying then, so you can get the earnings releases now. You don't really make the money kind of, afterwards. But one thing that is clear is these things are absolute juggernauts. I mean, talking about companies doing 90 billion revenue, in a quarter like Apple, or over $100 billion of revenue in a quarter like Amazon. That's 3 months. That's enormous. And so we get asked all the time, there's huge hesitancy, is this tech bust 2.0? You didn't see these numbers in the year 2000. This is real cash. These are very high margin businesses as well. It just shows that there's a real thing going on. This is where consumer dollars are going. And it's, these are really, tech is such a difficult place to invest in. It's complicated. Often you have to pay out for good companies, but it just shows that that you just have to do the work. You have to be exposed to this part of the market. Because these are the only companies really that are delivering these kinds of results at the moment. And any weakness really should be seen as a buying opportunity in our view.
So buying opportunity, what specifically, if I put you on the spot, Michael, would you be buying in that tech space in the US? Or again, do you look elsewhere to some of the software providers, some of the less well-known, trodden stories, the FANGs plus that we talk about all the time? Look,
I'd say the tech and growth space is divided into two now. There's kind of like these massive juggernauts, and then there's much faster growing smaller companies, and obviously some legacy companies that are not really growing that we don't really look at all. In our fund, we don't own the large companies because we're just trying to do things different, and people can get that exposure on their own. But they're extremely compelling. They're growing really fast. They're rock solid. Some of them have $100 billion plus of cash on their balance sheet. All those metrics are probably as good as you'll ever see. So they're kind of compelling, certainly compelling at these price levels as well. In the growth space, it's kind of the pointy end, those $1 to $25 billion companies that are growing 4 or 5 times as fast. Many of those are off 30-40%. And if we had to guess, there's probably going to take a while for the speculative excess of February to work its way through the system. That was a huge ramp up. There was enormous amounts of capital pulled out of the market by those SPACs and those IPOs. It usually takes months, like many months, for these things to kind of work their way through the system. But you have to take those opportunities as buying opportunities, If you go back to the previous times, there were these kinds of, the market got hot and tech sold off 20-30%. Sometimes, you had to buy at those levels, and the forward returns after those points were exceptional. So bizarrely, when things kind of look shakiest and things look scariest, often they're safest, and vice versa. When everything's going great, like say in February, where basically everything you bought, even companies who weren't forecasting revenue for 5 years or more at best, those things were flying and everyone was money making out of those. Everything looked great. That was when it was probably most risky. And now as prices have come down, you're getting to much more defensible levels, and kind of levels where forward returns, when you plug them into your models, start to look really good.
We all know the saying, be greedy when others are fearful. Let's see when that moment comes in the not too distant future, perhaps. Michael Frazis from Frazis Capital Partners. Always great to chat. Enjoy the rest of the day.